Margaret retired at 67, 28 years as a fourth-grade teacher in Cincinnati, Ohio, owned her house outright, $340,000 IRA, small pension. Her husband died in 2022. She sold their lake cabin the next year for $185,000. Her accountant told her, "Don't worry about the taxes, we'll figure it out at year end." So she did. She put the money in a CD, didn't withhold a dime. In April, she got a CP-14 notice for $31,000 in unpaid capital gains tax. She paid what she could, ignored the rest. 8 months later, a notice of federal tax lien hit her mailbox, filed against her house. Margaret had exactly 30 days to stop it. Her accountant never mentioned Form 12153. She missed the window. The lien is now public record on her home. The form that would have prevented it is free and takes 10 minutes to fill out. Nobody told her. Margaret is not unusual. She is what happens when a homeowner over 65 does not know about the 4 documents that stand between your house and a federal tax lien. If you own your home, are over 65, and have any kind of tax debt, an unfiled return, or even a clean record but a complicated estate from a deceased spouse, you are exposed. Not the renter down the street, not your neighbor with the mortgage, and no equity. You. The paid-off house is exactly the asset they go after. What you could lose is not theoretical. It is the largest asset most retirees will ever own. Today, I'm going to show you the 4 documents that keep the IRS off your title. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Frank Dalton. I spent 35 years as a CPA working with retirees before I stepped back from the practice. Every week on this channel, The Retirement Tax Vault, I break down the tax rules, the IRS traps, and the strategies that protect retirees from the things your advisor never mentioned. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me get into it. Document number 1, Form Salv 153, Request for a Collection Due Process Hearing. Let me start with the single most important piece of paper a 65-plus homeowner can know about. Form Salv 153, Request for a Collection Due Process or Equivalent Hearing. Here is what it does. When the IRS files a notice of federal tax lien against your property or sends you a final notice of intent to levy, that's letter 1058, also called LT11. The law gives you exactly 30 days from the date on that notice to file Form 12153. The day you mail it certified, every collection action stops. The lien filing pauses. The levy stops. You get a hearing in front of an independent Office of Appeals officer who has never touched your case before. 30 days. Not 30 business days. Not 30 days from when you opened the envelope. 30 calendar days from the date printed on the notice. Miss that window, and you lose 3 things at once. You lose the right to a CDP hearing. You lose the right to take your case to U.S. tax court if appeals rules against you. And you lose the leverage to negotiate, because once collection moves forward, the IRS has no incentive to slow down. Let me put a dollar amount on this so you understand the stakes. Tom, 73, retired engineer in Sarasota, Florida. He owes $48,000 in back taxes from a botched 401k rollover 3 years ago. The IRS sends him a notice of federal tax lien against his $620,000 paid-off home. Tom files Form 12153 on day 28. The lien filing freezes. He proposes an installment agreement at the hearing. Appeals approves it. The lien is withdrawn 9 months later, never recorded with the county. His neighbor, Carol, same situation, ignores the notice for 45 days. By the time she calls a tax pro, the lien is recorded with the county. It is public record. Her credit drops 120 points. Future buyers can pull it up on a title search. Refinancing gets blocked. Her homeowner's insurance premium bumps. Cost of ignoring one form, roughly $14,000 in financial damage in year one alone, before a single dollar of the actual tax gets paid. Here's what most retirees don't know. The 30-day window starts whether you read the letter or not. The IRS does not care if you were on vacation. They do not care if you were in the hospital. They do not care if your mail was forwarded. The clock runs from the date on the notice, which means the moment that letter is dated, the timer is already running. That brings me to the document you'll actually use to fix the underlying problem. Document number 2, Form 9465, Installment Agreement Request. Here is what it does. It lets you pay off your federal tax debt in monthly installments, and once accepted, it stops the IRS from levying your bank account, your Social Security, or moving toward your home equity. The rules: if you owe $50,000 or less in combined tax, penalties, and interest, you qualify for a streamlined installment agreement. No financial disclosure, no verification of your assets. They almost always say yes if your returns are filed and current. You pick the monthly payment. You can stretch it up to 72 months, 6 years. Setup fees in 2026 run roughly $31 if you set it up with direct debit online, $107 if you mail Form 9465 in. Low-income filers and most retirees on Social Security alone qualify, get the fee waived entirely. You can apply at irs.gov in about 15 minutes. Let me put a dollar amount on this. Walter and Diane, both 68, retired in Phoenix, Arizona. Walter took a $90,000 IRA distribution to renovate the house. The plan administrator withheld 20% federal DAO, but his actual marginal bracket that year was 32%. He owes $1,904 in April. He has 2 real options. Option A, cash out his Roth to pay the bill. That kills 6 years of tax-free growth, about $7,000 of compounding gone forever, in a bucket he can't refill. Option B, file Form 9465, pays $284 a month for 6 years. Total interest over the life of the plan, roughly $4,200 at the IRS underpayment rate. Option B costs him $4,200. Option A costs him $7,000, plus the loss of a Roth he cannot replace. The form saves him almost $3,000 and keeps the Roth intact. Here's what most retirees don't know. The IRS publishes an installment agreement application on its own website. You can apply, get approved, and have the agreement in writing in under an hour. You don't need an enrolled agent. You don't need to call a 1-800 number that puts you on hold for 2 hours. You sit at your kitchen table, fill out a web form, and the levy threat is dead. But here's the trap. If you owe more than $50,000, you don't qualify for Streamlined. You drop into the regular agreement track, which requires Form 433F or 433A, a full financial disclosure. They look at every account, every asset, including your home equity, which is exactly when document number 3 becomes the conversation. Document number 3, Form 656, paired with Form 433A OIC, Offer in Compromise. Here is what it does. It lets you settle your federal tax debt for less than you owe. In some cases, dramatically less, sometimes pennies on the dollar. The IRS will reduce the bill if you can show that collecting the full amount would create economic hardship or that they can't realistically collect it from your future income and assets. The rules: there are 3 grounds. Doubt as to liability, you don't actually owe it. Doubt as to collectability, you owe it but can't pay it. Effective tax administration, paying it would be unfair given your circumstances. For a 65-plus homeowner on a fixed income, ground number 2 is the lane that matters. Application fee in 2026, $205. Low income waiver available. If your household income is at or below 250% of the federal poverty line, the fee is waived and your initial payment is waived. The full packet is Form 656B, the booklet, which contains every form you need. Let me put a dollar amount on this. Eleanor, 76, widowed, retired bookkeeper, lives outside Pittsburgh, Pennsylvania. owns her home outright, $245,000 value, lives on $2,400 a month from Social Security and a small pension, owes the IRS $61,000 from her late husband's underreported consulting income. The IRS calculates her reasonable collection potential. That's the number that drives the offer. Monthly income minus IRS allowed living expenses, multiplied out by the time they'd have to collect, plus net asset value. The home equity is partially counted, but discounted 20% for quick sale value, and her allowable living expenses for an older single adult eat up most of her cash flow. Eleanor's RCP comes out to $14,200. She submits a lump sum offer of $14,200 against a $61,000 debt. The IRS accepts. She wires the money. The remaining $46,800 is wiped. The lien is released within 30 days. Here's what most retirees don't know. The IRS publishes an offer and compromise pre-qualifier tool on its website, MAR, for free. You answer about a dozen questions, and it tells you whether you're a candidate before you file a single form. Not every offer gets accepted, but the pre-qualifier is the hour of work you do before you spend $205 on the application. Now, what happens when none of those three doors work? When the IRS won't grant you a hearing, won't approve your installment plan, won't accept your offer, and is actively moving toward seizure? That's when the fourth document becomes the only thing left. Document number 4, Form 911, Request for Taxpayer Advocate Service Assistance. Here is what it does. The Taxpayer Advocate Service is an independent organization inside the IRS. Emphasis on independent. They report directly to Congress. Their job is to step in when the regular IRS machinery is failing you, has been unresponsive for too long, or is about to cause significant hardship, including the seizure of a primary residence. The rules. You qualify for TAS help in 4 scenarios. Economic harm. You are suffering or about to suffer financial damage. Significant cost. You're paying more than you should because of an IRS error or delay. Long delay, over 30 days past a deadline with no response. Or systemic problem, the issue affects more than just you. For a homeowner over 65 facing collection action, economic harm is the magic phrase. Threatened loss of housing is one of the clearest hardship triggers TAS recognizes. The form is 2 pages. It is free. There is no fee. There is no filing deadline. Once submitted, a case advocate is usually assigned within 5 business days. They have authority to issue a taxpayer assistance order, which can force the IRS to stop collection action immediately while your case is reviewed. Let me put a dollar amount on this. Robert, 81, retired civil servant in Tucson, Arizona, owns a $310,000 home outright. The IRS is moving towards seizure for $94,000 in old debt, including penalties his late wife accrued before her death. Robert's regular installment agreement application has been in review for 7 months. Each month adds roughly $1,200 in penalties and interest. The collection officer keeps changing. Robert files Form 911 with TAS, case advocate assigned in 4 days. The advocate pulls his file, identifies that 60% of the original tax was actually his deceased wife's separate liability, applies for innocent spouse relief on his behalf, and brokers a $19,000 settlement on the rest. Total time, 4 months. Total amount paid, $19,000 against a $94,000 demand. Here's what most retirees don't know. There is at least one taxpayer advocate office in every state. The number is 1-877-777-4778. You can also fax Form 911 directly to your state's TAS office. The IRS will not tell you about this option in their collection notices. They are not required to. TAS exists precisely because the regular collection process can grind people into the ground, and it is the one door inside the IRS that does not close at 5 p.m. on day 30. Let me give you a real example of how all 4 work together. Take Frank and Susan, both 72, retired teachers, paid-off home in suburban Atlanta worth $410,000. Combined Social Security plus pensions, $79,000 a year. They got hit with an unexpected $58,000 tax bill from a Roth conversion they didn't fully understand. Their advisor had them convert $250,000 in 1 year, which spiked their bracket and triggered IRMA Medicare surcharges on top. Without these documents, here is what happens. They get the CP14, panic, ignore it. 8 months later, notice of federal tax lien against their house. 6 months after that, levy on Susan's pension. 18 months after that, the IRS files for judicial seizure of the home. They lose another $40,000 in penalties, interest, IRMA bumps, and credit damage along the way. Their kids end up writing the checks. With these documents, here is what actually happens. They file Form TAOS 153 within 30 days of the lien notice, collection halts. They submit Form 9465 because they owe under $50,000 after a partial payment from savings. Installment agreement approved at $620 a month. They run the Form 6556B pre-qualifier. They don't qualify for an offer in compromise because their income is too steady. Fine, that door closes. The others are open. They file Form 911 anyway because the original IRMA penalty was based on a 1-year income spike that distorted their assessment. TAS advocate gets the IRMA portion adjusted, knocking $4,800 off the total. Same tax debt, same income, same house. 2 completely different 5-year outcomes, the difference being 4 pieces of paper. Let me bring it all together. Here are all 4 in order. 1. Form 12153, collection due process hearing request, filed within 30 days of a notice of federal tax lien or a final notice of intent to levy. Stops everything, the single most time-sensitive document on this list. 2. Form 9465, Installment Agreement Request. For tax debt of $50,000 or less, no financial disclosure required. Stretches your bill over up to 72 months. Stops the levy threat dead. 3. Form 656 with Form 433A OIC, Offer in Compromise. Settles your debt for less than you owe when collection of the full amount would cause hardship. Pre-qualify on the IRS website before you spend a dime. 4. Form 911, Taxpayer Advocate Service Request. Your independent escalation when the regular IRS machinery fails you or is moving towards seizure. Free. No deadline. Every state has an office. 4 documents the IRS expects you to know. All of them matter. Most homeowners over 65 know 0 of them on the day the first notice hits the mailbox. And every single one you miss is a step closer to losing the house. This is Frank Dalton. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need it before the lien notice shows up. If you're not subscribed yet, hit subscribe and turn on the bell so you don't miss the next one. The video I'm working on next breaks down the single biggest IRMA mistake retirees made on their 2025 Roth conversions. You need to see it before the 2026 reassessment letters go out in October. And if you know someone over 65 who has any kind of tax debt or an unfiled return sitting in a drawer, send them this video today, not tomorrow, today. Because if a notice of federal tax lien is already in their mail, the 30-day clock on Form 12153 is already running, and they don't get those days back. Drop a comment below. Tell me which one of these 4 forms you had never heard of before this video. I read every single one, and the most common situations become future videos. I'll see you in the next one.